the bulls took it on the chin. The markets ended Friday with sharp cuts. However, for the week, not much was done. It was no different actually for the Nifty and the Sensex. But overall, the Nifty got back to that 18,000 mark this week. So psychological levels were conquered. This is Editors Roundtable. Thanks so much for joining in. I'm Sonia, and today I have with me, of course, all our editors, Prashant, Anuj and Nimesh, and a special editor here with us in the studio, Ridham, Desai. And when you see Ridham in the studio, you would know that animal spirits perhaps are back, right? I mean, that's the only reason he would be here with us. Are the bulls back, Ridham?
Yeah. You know, I'll share one piece of statistic with you. The world GDP is $103 trillion. Next year, global GDP growth is estimated to be about 2.5%. 1/6 of that will come from India. India is only 3% of world GDP.
And by the way, Ridham has weathered all the rain and hail and storm and all of that. Mumbai rain was trending on Twitter, I saw. I mean, we've been
not
inside
only that,
the studio,
Prashant,
but
among all of us, he's been still the fittest of all.
Oh.
And the kind of fitness
I was kind of hoping that you would avoid that topic.
So the market's fitness is proportionately improving to Ridham's fitness, right? Ridham, what do you say?
I don't know about that. You know, fitness is a state of mind. It's not the state of the body.
But Ridham, you should come to our office more often. You've come after about 3 years. You should come more often, Ridham.
Yeah, so Anuj, I've not been to any place for 2.5 years. So yeah, for most places, I'm going there for the first time in 3. But I was just checking with Sonia. I think I was here when the office opened, which she reminds me was around early 2020.
Correct.
So yeah, it's a little less than 3 years, but yeah, hopefully. It's not very far from my office, so I can probably come here.
Hop, skip and jump.
Hopefully
not in terms of distance, but in terms of time. In Mumbai traffic.
I have lots of time on hand, don't worry. I have more time than I can. I had to actually, almost kill time to wait for 3:30 before I left for this.
By the way, not many people know that when he was to, lift weights and all, he used to do gymming at 2:33 in the afternoons during office time.
I'll tell you.
That was the kind of passion he had.
An anecdote. This is 2006 or 2007. We were shooting at one of the 5-star hotels. I was wearing, full suited, booted, jacket, tie, and I reached the venue to shoot, and there's this really fit, buffed up person walking towards me.
Prashant,
how do you feel about that?
I kept my jacket on.
I switched on CNBC today at around 2:30 to check what attire you have, because I didn't want to be underdressed.
Okay, well, as we talk about Ridham's fitness, the market's fitness has also improved, right? Anuj, I mean, overall, I know there were some bumps along the way and there's a big event upon us, the US Fed policy, but overall, this market has been fit and fine, and how?
It has been, though, nothing surprises me in the world anymore. When you can have the highest amount of rain in the season on 16th September, not just in Mumbai, but here in Delhi as well. And really some very interesting things are happening in the world. But I think, Sonia, I want to point out 4 street signs this week, which have given some kind of warning signs. I think Friday was brutal in terms of the market breadth. Because if you look at what happened in the market, today we had 1:6 on advanced decline, and the market leading sector was leading the decline, which is something I always give extreme importance to. I know we talk about near term here and not the 5-year views, but just in the near term, if you look at the kind of selling that you saw in M&M and Hero MotoCorp, in fact, second week of underperformance is what we had for the Nifty Auto. The other point which clearly stood out was that the counter trend rally which we were building in IT, that got punctured this week. The Nifty IT was down 6% for the week and very close to 52-week low. In fact, within 2.5% of 52-week low for the Nifty IT. And again, led by the sector leader, Infosys. The kind of selling that we saw in Infosys towards the end on Friday was a bit eerie, and most large stocks are close to 52-week lows. The third sign to watch out for is what is the smart money doing? Though, you could argue the definition of smart money in this market because retail really bought when everything was capitulating, and FIs actually have bought at the higher level. But even then, over the last few days, you started to see some bit of fatigue from the FIs as well, at least in the cash market. And in the futures market, they're actually building some very aggressive short positions. I don't know why is that the case, but 76% on the short side from the FIs, if you look at the index futures. And one last sign, and that's really a question. And actually, I'll throw that to Ridham. The question really is that, is the decoupling still intact? Because while the Indian market is still an outperformer, is this 2004 or 2008? In 2008 as well, there was a lot of noise about decoupling, but when the market caught up with US market, we actually saw a big decline. Actually, Ridham, let me ask you this question. Is the decoupling still intact?
See, Anuj, every single US recession of the last 30 years has produced a bear market in India. So that we may skirt a bear market this time is your version of decoupling. I'll say less coupling. Decoupling is a little too dangerous to say. But we cannot be completely immune to global events. The fact is that we are amongst the top 5 world economies and world markets. So we will get affected by global events, maybe with a lag, but we will get affected. So if the SPX is going to keep making lower levels, then it's hard for the Nifty to make a new high. And very appropriately, we didn't actually make a new high. We came off as soon as we were all excited about a new high. It's a good sign, I think. You don't want the market to get too exuberant and run away and then crash. So it's better that we correct and behave more sensibly, as I think we have done this week.
I think in that context, with the inflation data that came out from the US, right, now the expectations are that maybe not 75 basis points, it could be 100 basis points hike as well in the meeting next week. That's the big event to watch. But the other big event that Prashant is tracking closely is India's inclusion in the global bond index. What would the implications of that be?
I mean, it's a big if, right? If it happens or not. Let me go across to the big wall and tell our viewers what this could be, this could look like. And I'll tell you why we are talking about this now, right? So this is the big event ahead. I should have probably put a question mark here because hopefully this will happen. Inclusion of Indian government bonds to global bond indexes. I mean, the chatter is growing that this is very imminent now. It could come any day, actually. Some that I've spoken to, or maybe it'll come towards the end of this particular month. Now, you know, the story, let me just tell you the story so far. India is the only large emerging market which doesn't have its government securities as part of global bond indices. India opened its equity markets fully to foreign investors in 1993, but it's been cagey about doing the so for bond markets, primarily because the concern has been that, you know, hot inflows and hot money outflows of course more worrisome, could have a big impact on the currency market. So it's been kind of held back in opening up the bond market to global investors. But things started to change from 2013, 2014. Let me just quickly tell you, the various steps which have happened along the way, the road to the global inclusion. You know, there were various foreign investor categories which all got merged. FII, QFI, it all became FPI. There were revisions which happened as far as some certain quantitative restrictions in terms of how much foreigners can buy of Indian government bonds. There were things like, you know, the government waiving limits through the voluntary retention route. The last one which happened was a separate category of bonds which was created, which was called the FAR, the fully accessible route. So foreigners could buy bonds which were sort of put in this bucket, the FAR bucket, the fully accessible route bucket, in unlimited amounts. Okay, so this is the story so far. Why are we saying that this may happen now? What has really changed, right? What has changed is a couple of things. India, first of all, has been on the watch list of index managers like JP Morgan, FTSE, etc. This is like the MSCI Emerging Market Equity Index. I mean, in the same way that they have, these indices for stocks, you have indices for bonds as well. The big event which happened earlier this year was Russia, with its 8 to 10% weight in some of these global indices, got excluded because, of course, its annexation of Ukraine. With Russia's exclusion, these indices became very unbalanced, and as a result of which, like it's happening in equities and bonds as well, investors are now asking these index managers like JP Morgan or Barclays or others to include India. I mean, India is one of the largest and most, not largest, but it's a very liquid market out there, and investors are now putting pressure on these index managers and saying, well, we have no problem, we'd be happy to buy Indian bonds, so why not include them? And that's the reason why, let's just go back for 1 second, that's the reason why, even though government securities are still not on international clearing platforms like, Euroclear, it's no longer a problem for investors. So this is essentially what has changed. JP Morgan is the index manager which announces the decision of its review sometime in September historically, and that's why we are saying the moment could be now. This is a quick overview of the Indian GSEC market. These are latest numbers. The total GSEC market size is about 86 lakh crores. The bonds which are owned by FPIs
through the fully accessible route in that bucket is about 59,000 crores. The non-FAR bonds which are owned by FPIs is another 82,000 crores. In total, foreign ownership of government securities is 1.41 lakh crores. It's about 1.6% of the total. What could the inclusion look like? I've just taken two examples, the Bloomberg Barclays Index and the JP Morgan Emerging Market Index. These are the passive AUM funds which track these particular indices, and look at what potential weights could look like and the inflows which we could see. A one-time potential inflow of $30 to $40 billion could come through if India is made part of it. And according to Morgan Stanley, after this, you could see about $18.5 billion in the every year over the next decade or so, taking the total weight of foreigners of India in these indices to about 9% by 2031. By the way, this is Indian foreign ownership of government bonds. India is at 1.6%. Look at other countries. There is absolutely no comparison. The implications you asked, I mean, obviously, there is another new set of buyer for these bonds. So bond yields head lower. That's a reduction in the cost of capital. It's, of course, positive implications for equities as well as a result of, new set of buyers and the lower cost of capital. And, of course, INR could see appreciation because of that, but that will have to be managed. This is the past timeline for inclusion in the bond index, and what could really happen from here, which we will put out as well. I mean, so this is a big one. This is the table. So China, it was put on the watch list in June of 2017. The announcement came in September 2019, and the inclusion finally happened in February of 2020. In India's case, we are awaiting, but this is going to be a milestone for the Indian bond market with implications across the board. Back to you guys. Nimesh, I mean, from bonds back to equities, what are you picking up as far as, market sentiment, and what are market participants telling you?
Well, Prashant, if you look at this week's correction from the top, it looks like more of a consolidation. But again, it's not come as a bit of a surprise, because if you remember last week, there were feedbacks from dealing rooms that there are some signs of warnings. Like, the way some of the mid caps were rallying, everybody was making money, everybody's calls were going right. There were some signs that, one need to be a bit cautious and be watchful as well. So that was a clear message, and it's actually playing out. And even some of the smarter investors seems to be booking out. Not like they're selling out completely, but there is a bit of profit booking as well. So that's played out this week clearly, for the Indian markets. But from a long-term perspective, from the overall perspective, looks like the outperformance may continue for a couple of reasons. One, as even Ridham explained, there is a lot of stickiness to the domestic inflows, right? So that's playing out. At the same time, there is FI money as well. I was shared some data from large institutional investors, and the feedback is, look at the divergence what India had vis-a-vis Hong Kong and China, and maybe Ridham can explain us more. There's been a big divergence this year. Why today? It's never happened for many years, and maybe that also explains that within emerging markets, the flow is moving from China to India, and that's playing out in terms of the FI flows as well. So that's something to watch out for. I guess still there are few though warning signs, but from a liquidity point of view, do watch out for the FPI, FIF strategic stake sales. So the supply of paper still is quite there. So that's something to clearly watch out for. But I guess, Ridham, I can ask you something. For the last many weeks now, there has been a trend of FI, strategic investors, Ps looking to sell out. Is that a bit of a warning sign? And to you, what are the other warning signs that you watch out for, for the near-term exuberance to match as to whether markets are at an exuberant level?
So on venture capital and PE funds, there's a fair bit of stress in the world.
Right.
So the flows have slowed down significantly. If you go back a few months, the trailing 12-month number was $50 billion. That was the VC funding into India. That run rate from 4 billion has now dropped to 500, 700 million latest month. So it's a big drop in fact, bulk of the BOP pressure is because the venture funding has slowed down. It may get replaced with the bond fund story. It's one of the reasons why there's a bid on financials, amongst other reasons, because financials will benefit. Yeah, there's, it's not a warning sign, it's just the amount of stress that's there in the VC world.
No, apart from the private equity investors, we are seeing a lot of strategic guys selling out, right? Like in Indigo, there was Ganwal. Oh, obviously, he had already announced that he's going to sell. But I'm seeing a lot of promoters selling out, a lot of strategic investors selling out, big chunks, 5%, 10% in block deals. what to read into this? Is there something that one should be careful about, and what?
So I think, Nimesh, the reasons are different for different sell downs. So, for example, there are a few PE funds that have to shut down. So they have to report. They have to take the money off the table, and if they don't have fresh funds coming in, which is the case with a lot of PE funds, then they have to sell. Otherwise they can transfer to a new fund. So that could be one explanation. There are other people looking to invest in other places, and that's why they are selling some stock. I don't read much into it from a top-down singular reason perspective.
Sure.
Okay. Yeah. Well, one sector that I have to ask you about is the big comeback that we've seen in the auto sector, right? But before that, I just want to get some data points on board. So let me go to the big wall now. Now, what happened this week is the autos made a huge comeback after many years of a slowdown, right? So the big question that we're asking is this a structural uptrend? Now, let's take a look at the auto stocks hitting fresh highs. M&M hit an all-time high last week. Maruti is at a 4-year high this week. Ashok Leyland all-time high. Seat all-time high. JK Tyres 4-year high. So there's a clear trend over here. Autos and ancillaries are hitting fresh highs. Now, is the risk reward turning favorable? So let's give you some data. In the last 5 years, between FY17 to 22, the earnings, the compounded earnings of the auto sector fell by 6.7%. And the share in the profit pool for Motilal Oswal in the companies that they track, this is the data that they provided, went from 9.2% all the way to 2.5%. So it was a very low share in the profit pool. Now the question we're asking is the risk reward now turned favorable because of a couple of reasons? Autos, as we know, has made a huge comeback. If you look at just purely the data, right, demand from OEMs has grown quite a bit. Passenger vehicle sales have gone up 21% just in August. Two-wheeler sales have gone up 16%. But I think the biggest trigger from an operational perspective is the fall that we've seen in raw material prices. Just look at the sharp fall. Aluminum, steel, natural rubber, all down anywhere between 30 to about 41% from the highs just a couple of months ago. 2022 and 2021 highs. So this is, of course, the second reason. The other thing that we're noticing is that SUVs, the segment has grown rapidly, and that takes us to the premiumization angle, where people want to upgrade to better cars, to, there's higher kit value for many of these auto ancillaries. New launches. In fact, M&M told us that the B&C segment now has a market size of 98,000 units per month on which they want to capitalize. Finally, the premiumization beneficiaries are, of course, many of these tyre stocks, and perhaps that's the reason why you saw them rally, because they have better safety measures in the tyres. Also, for example, right, Apollo Tyres has a Vredestein brand, which is much more expensive than a normal Apollo Tyres, 40% more expensive, and they recently launched it in India, and now it's in all the SUVs, the new launches. So that's, of course, one trend. And finally, the commercial vehicle growth. Just look at the moves we've seen this year. Overall, CV is up 76%, MHCV is up 108%, and LCV is up 63%. So that's the big question we're asking. And in fact, I want to toss this question to you, Ridham. Welcome back. Before the break, we spoke about how autos has come out of a long, degrowth cycle. Ridham of Morgan Stanley is with us, sitting here. Ridham, what do you feel? You think that this is the time to buy?
Yeah, I agree, actually. I think we've been in a 10-year down cycle, actually, not just 5. And there's a huge amount of pent-up demand, and discretionary incomes are rising. India has crossed that threshold of $2,000 per capita income. At that point, a lot of these things actually will, see exponential growth. So it's a comment I'd make about discretionary consumption in general and autos in specific. Only thing you have to be careful about the electric vehicle disruption. So in the auto parts industry, you can buy a lot of companies that will not be touched like tires by electric vehicle disruption, because you need tires whether it's electric or non-electric.
What else, Ridham, is top of mind?
Real estate. I think real estate looks good. Again, very similar theme to autos. Of course, stocks have done very well. So you buy your stocks when the valuations, are in your favor.
You think there's a longer runway for which will last the cycle?
I think residential demand is just about starting and is probably entering into a long-term upcycle. So we should see a fairly good, and this is a little different from the 03-07 cycle where developers focused on buying land at cheap prices and then making money out of it. Now it's a more conventional real estate sector which is driven by turnover, so volume. Sure. So I think we have matured as a real estate industry, and this looks quite interesting.
Ridham, defense is emerging as a big sector, right? We had Ramesh Damani last year. He was making this point that this could be a massive sector. Initially, of course, just one or two stocks, but now this list is expanding, and some serious investments coming in this space. Are you bullish here?
Yeah, see, Anuj, you can trade there. I'm not so sure about the secular story in terms of stock market, because usually it's a difficult business. Revenues are lumpy, working capital cycles are long, return on capital gets challenged, you're dependent on the government for your order book.
And a lot of balance sheets are stretched also.
Yeah, so it's there is a flavor right now which will probably go on for a while, and of course there is a story out there, but making money in the stock market is a little different. So I wouldn't puncture the story right now. I think there's some legs left, but longer term I like to focus on businesses that generate return on capital, have tight balance sheets, don't have long working capital cycles, don't have lumpy revenues. These are easier businesses to own and sleep on.
Ridham, lastly, before we let you go, what about the mid-cap and small-cap? Because in your reports also you keep advocating that there is still a lot of room for mid-caps and small-caps to do well. And there is a larger audience in CNBC who tracks mid-caps and small-caps.
So Nimesh, when the profit cycle is on its ascent, it will favor mid-caps and small-caps. Those companies will obviously, now see the share of profits were at the share of large company profits were elevated 2 years ago. Now that has corrected a fair bit. But I think mid-caps and small-caps will still grow faster.
Is that what we saw in 2003, 2008? The mid-cap, small-cap party had a huge outperformance over
Absolutely. We saw that, and it is but natural, right? It's much easier to grow if you're a small company than if you're a large company. Also, the other thing is that in the last 10 years, when India was in a growth slowdown, large companies gained a lot of share because they didn't have balance sheet stress. A lot of small companies lost share because they had balance sheet stress. They had to deal with the GST transition. A lot of that is now in the bag.
Okay, so we're wrapping up with the show. One word answer. Diwali is not too far away. So 19,000 on the Nifty or 17,000?
Sonia, how does it matter what the index does? Stay put there, be a long-term investor. Equity is only for long-term investing, and the result will be good. I keep telling my folk, everybody is going to die, but dying poor is a sin. Die rich.
I mean, I like this version of Ridham. There's a bit of a philosopher in him, right? I mean, I like it. It's
morbid philosophy.
Not morbid. I mean,
Ridham, the problem in Ridham in India long term is 3 days.
No, that's not true. And sorry, I may be extending this show for a while, but somebody was challenging me about domestic flows, saying that this balloon will get punctured. And I said, listen, India has 150 years of equity investing culture. And those who don't have memory, in 1992, just before the Harshad Mehta, bull market ended, 25% of household savings were going into equities.
Wow.
Just to give you the context in today's terms, $700 billion is household saving. 25% of that is almost $200 billion. We are nowhere there. We're still scratching the surface. So.
I told you Ridham was in a good mood today, right? Yes. Okay, on that very optimistic note, Ridham, thanks a lot for joining in. And you folks have a great weekend. Thanks for watching Editor's Roundtable.